In the next market crash, most people will do what feels safe and quietly destroy years of progress. A smaller group will do something uncomfortable instead and slowly build wealth while fear is everywhere. Same crash, same headlines, completely different futures. And the scary part is, you probably won't decide what you do during the crash. You'll decide before it ever happens. Because when panic arrives, people don't rise to the level of their knowledge. They fall to the level of their system. In the next few minutes, I'll show you the psychological trap that causes most investors to fail, the simple system long-term investors rely on during uncertainty, and 4 practical rules that help people stay calm when everybody else is panicking. Because when markets fall, your investment strategy matters. But your behavior matters more, and most people don't lose money because markets crash. They lose money because they interrupt compounding. If you study many self-made millionaires carefully, you'll notice something surprising. Most didn't become wealthy by predicting every crash, or chasing hype, or constantly jumping in and out of the market. Instead, they quietly built ownership in real businesses over very long periods of time. And they understood something most people never truly accept. The moments that create long-term wealth usually feel terrible while you're living through them. In 2008, people thought the financial system was collapsing. In March 2020, investors feared the global economy might shut down completely. Fear felt rational. And yet, some investors quietly kept buying anyway, not because they were fearless, but because they had a system already prepared before panic arrived. That's the difference, because the market often transfers wealth from emotional investors to systematic investors. Human beings are wired to avoid pain, so naturally, in finance we look for what feels safe, and cash feels safe. No volatility, no red numbers, no stress. But what feels safe in the short term can quietly become dangerous over the long term, because there's an invisible force constantly working against idle money. Inflation, prices slowly rise, groceries become more expensive, housing becomes more expensive, healthcare becomes more expensive, and over time your money quietly loses purchasing power. Now, to be clear, emergency cash is important, very important, but there's a difference between cash for stability and cash for long-term wealth building, because stability protects today, but ownership builds tomorrow, and that distinction changes financial futures.
Let's make this real. 2 friends, Michael and Daniel, same age, same income, same starting point, but completely different behaviors. Michael looked at the market and mostly saw risk, so he kept most of his money in low-return, ultra-safe options. It felt responsible, stable, predictable, comfortable. Daniel approached things differently. He built a system every month, before lifestyle upgrades, before luxury spending, before impulse purchases. A fixed amount automatically went into low-cost diversified index funds. No guessing, no market timing, no emotional decisions. At first, the results looked boring. Year 1, not much happened. Year 2, still slow. And honestly, this is the stage where most people quit, because compounding feels invisible in the beginning. It doesn't feel exciting. It feels painfully slow. But quietly, something powerful was happening underneath the surface, because eventually, compounding reaches a point where growth starts accelerating faster than effort. And that's when investing starts looking almost unfair. And then one day, the real test arrives. The market crashes 20%, 30%, sometimes even 50%. Headlines become terrifying. Fear spreads everywhere. And suddenly, your brain stops thinking long-term. It enters survival mode. Sell. Protect yourself. Stop the pain. And this is where most investors make the mistake that changes everything. Not because they're stupid, but because panic feels like relief. Be honest with yourself for a second. If your investments dropped 40% tomorrow, would you actually keep buying? Most people imagine they would, until it really happens, because market crashes are easy to handle in theory and emotionally brutal in reality. But here's the irony. The market often rewards behavior that feels uncomfortable and punishes behavior that feels emotionally comfortable. People say, "I'll invest again when things feel safer." But historically, when things finally feel safe again, a huge part of the recovery has already happened, and years later, many investors don't regret market crashes, they regret selling during them, because crashes themselves rarely destroy long-term wealth. Panic usually does. Let's look at a real example. In early 2020, global markets fell rapidly as uncertainty spread around the world. Many investors panicked. Others simply continued investing every week. Imagine someone investing $500 every week throughout the market decline. They weren't trying to predict the bottom. They simply kept buying as prices became cheaper. As markets recovered over the following years, many of those index funds and ETFs purchased during the panic ended up gaining 50%, 70%, or even more depending on when they were bought. The lesson isn't that every crash recovers immediately. The lesson is that regular investing during periods of fear allows you to accumulate more shares at lower prices, and when recovery eventually comes, those investments dramatically increase long-term returns. That's why disciplined investors don't just survive market crashes, they often use them to strengthen their future wealth. Now let's look at something simple, but incredibly important. Suppose both investors contribute $1,000 every month for 20 years. Michael earns around 4% annually, Daniel earns around 10%. After 20 years, Michael ends up with roughly $367,000, and Daniel ends up with roughly $760,000. Same income, same monthly effort, same starting point, completely different outcomes, and the difference wasn't intelligence, it wasn't secret information, it was consistency, compounding, and behavior during difficult periods, because eventually, your money starts working harder than you do, and that's when wealth creation truly changes speed. So how do smart long-term investors stay invested without becoming reckless? They follow a few simple rules. Rule 1, build an emergency fund. Keep roughly 6 months of essential expenses in cash, separate from investing. This creates breathing room during difficult times and prevents you from being forced to sell investments during market crashes. Because forced selling destroys long-term compounding. Rule 2, automate investing. Automate your investing. Remove emotion from the process. Some months you'll buy high, some months you'll buy low. Over long periods, consistency matters more than perfect timing because systems outperform motivation. Rule 3, increase slightly during major drops when markets fall significantly, and only if your financial situation is stable. Consider increasing your investment amount slightly, even 5% or 10%, not to predict the bottom, not to gamble, but because lower prices can become powerful opportunities over very long periods, only if it's financially safe for you. Rule 4, reduce panic media. Financial media profits from attention, and fear captures attention better than calm thinking. During market crashes, you'll constantly hear phrases like, "This time is different." Sometimes it is. But panic headlines have existed during almost every major downturn in history, and reacting emotionally to daily headlines is one of the fastest ways to interrupt compounding. So reduce the noise and focus on your long-term system instead. At some point, another market crash will happen, headlines will panic, people will say, "This time is different," fear will spread again, and most people will react emotionally again. But future wealth is often built during periods of uncertainty, quietly, patiently, systematically. Because the next crash won't just create fear, it will quietly create future millionaires too. And when that moment arrives, you won't rise to the level of your knowledge, you'll fall to the level of your system. So the real question is, when uncertainty returns, will you panic with the crowd or quietly continue building while everyone else steps away? Because that decision may shape your financial future more than almost anything else. And I'm genuinely curious, if the market crashed 40% tomorrow, what would you honestly do? Keep investing, pause, or panic sell? Let me know in the comments and please subscribe, and I'll see you in the next one.